Okay, let's unpack this. Even if you've been dabbling in options for a bit, or maybe you just got stock warrants from your employer, that moment hits you. You're staring at them thinking, okay, wait, how does this get taxed? Or maybe just, what am I supposed to do with this?
Hmm.
You've given us a really fascinating set of sources here, all about the, let's say, tricky world of financial derivatives, specifically options and warrants. And our mission today, cut through that complexity, taxes, yes, but also how to actually use those warrants.
It really is striking, isn't it, how often people jump into these instruments without fully getting the tax side of things. It's not just about making a profit. It's about what the IRS actually sees when you make that profit or, even when you take a loss. This deep dive should give you that essential framework so you're navigating with, let's say, more clarity.
Exactly, and it's often those little tax rules that catch people out. So the plan is explore the tax consequences for calls and puts, look at different scenarios, closing positions, covered calls, straddles, the works. Then we'll switch gears and try to demystify exercising or selling stock warrants and what that actually means for you. Right, let's start at the beginning. Why does trading options even trigger taxes? It seems obvious, but if you're trading options, you're pretty much guaranteed to be creating taxable events, things you have to report to the IRS.
That's absolutely right. And the key thing for listeners, I think, isn't if you'll owe taxes, but what kind of tax? Is it short-term capital gains, tax like regular income, or potentially long-term at a lower rate? It depends on things like how long you held the option, the strategy. Lots of option profits end up as short-term gains. And how you calculate those gains or losses. It really varies. So yeah, understanding the basics is crucial. It hits your bottom line directly.
Okay, let's get specific then. Exercising an option. How does that actually change your tax picture? Let's take calls first. The sources had a good example, company ABC. Say you buy a call option, pay $100 in premium for 100 shares at a $20 strike. If you exercise it when the stock's maybe $22, that $100 premium, it gets added to your stock's cost basis. So $20 strike times 100 shares, $2,000, plus the $100 premium. Boom, $2,100 cost basis. Then if you sell those shares later, say for $2,800, maybe you exercised in June, sold in August, held less than a year. That's a $700 short-term capital gain.
And a really critical point there. Short puts and short calls,
Yeah.
when they expire or you close them out. Always short-term gains or losses. Doesn't matter how long you held the contract open. Always
Man,
short-term.
always.
Which, raises that important question. Why does this short-term versus long-term thing matter so much for your planning?
Hmm.
It's all about the tax rate. Ordinary income rates versus those potentially lower long-term cap gains rates.
Yeah.
And puts, similar idea. If you exercise a put you bought, and you already own the stock, the premium you paid, plus commissions, gets added to the proceeds from the sale, effectively reducing your gain or increasing your loss on the stock itself. If you exercise a put and didn't own the stock beforehand, it's treated a bit like a short sale. Tax rules get complicated there. Holding periods start from exercise.
Okay, but what if you're just trading the options contracts themselves, not necessarily exercising them or dealing with the underlying stock directly?
Right, just pure options plays. In that case, gains and losses are calculated when you close the position, sell an option you bought, or buy back an option you wrote, or if they expire worthless. And remember, any short option puts or calls that expires worthless, that premium you collected is a short-term gain, period. The sources give us Taylor's examples. Taylor buys a put for $3, sells it for $2. That's a $100 short-term loss, $1 difference by 100 shares. Or Taylor writes a call, gets $4 premium, has to buy it back for $5. Again, $100 short-term loss. But here's a twist. Taylor buys a call for $4 premium, holds it for, say, 14 months. It expires worthless. Because they held the long call for over a year, that $400 loss is a long-term capital loss.
Ah, okay. That holding period distinction. This is where it starts getting really interesting and frankly a bit confusing for many people,
Yeah,
especially with strategies like covered calls. They're popular, but wow, the tax layers.
they really do add complexity. Let's take at or out-of-the-money covered calls first. Three basic outcomes. One, the call expires worthless. Say Taylor sold a $50 strike call on Microsoft, got 95 premium. MSFT stays below $50, say 48 at expiration. Taylor keeps the $95 premium. That's a short-term capital gain, even if they held the stock for years and wrote the call months ago. The premium on expiration is always short-term.
Always short term for the premium received on expiration. Okay.
2. The call gets exercised. Taylor bought MSFT way back at $37. Sold that $50 call for 95 cents. Stock goes above $50, gets called away. If this all happened within a year of buying the stock, the gain is short-term. It's calculated as $50 strike 37 basis plus 95 premium, so $13.95 per share short-term gain. 3. Taylor buys the callback before expiration to close it. Then it's a short-term or long-term gain or loss on the option itself, depending on how long that specific option position was open. But a really critical point, especially within the money calls, is this difference between qualified and unqualified covered calls. This can massively change your tax situation. An unqualified call, taxed at short-term rates, even if you've held the underlying stock for like 5 years.
That is a huge one, a potential trap. So beyond the rules, what's the thinking there? Why does the IRS draw this line between qualified and unqualified, especially for ITM options?
It's about risk, essentially. The guidelines are, well, pretty specific. To be qualified, the call generally can't be more than one strike price below the stock's closing price the day before you wrote it, and it needs more than 30 days left until expiration. If it doesn't meet those tests, the IRS sees it as unqualified, because the deep in the money call gives you so much downside protection. It's almost like you haven't got the full risk of owning the stock anymore.
Ah, okay, so they suspend the holding period.
Exactly. They suspend your holding period on the stock while that unqualified call is open. It's treated more like a short-term hedge than a long-term investment hold. Let's use Taylor's MSFT example again. Held MSFT over a year, cost basis $36. Stock closes May 22nd at $46.90. Taylor writes a June 5th $45 call for $2.65 premium. June 5th is less than 30 days away, and $45 is more than one strike below $46.90. One strike below would be $46.50.
Okay, fails both tests then.
Right, so it's unqualified. Taylor's long-term holding period on the MSFT shares. Suspended. If that call gets exercised, boom, short-term capital gains, even on stock held over a year.
That unqualified rule, it really underscores how careful you have to be. One wrong strike or date, and your long-term gain vanishes. Definitely makes you want to double check.
Yeah.
Okay, let's shift slightly. Protective puts and the infamous wash sale rule.
Protective puts are maybe a bit simpler, but still have wrinkles. If you've held stocks for over a year and then buy a put to protect it, fine. Your eventual gain on the stock is still long-term. But if you've held the stock for less than a year when you buy that protective put, your holding period for the stock freezes or gets wiped out, basically. Any gain when you eventually sell the stock becomes short-term, regardless of how much longer you hold it after buying the put.
The clock stops.
Pretty much. And same idea if you buy the stock while you're already holding a put on it. Short-term treatment applies.
And the wash sale rule? That's not just for selling stock at a loss and buying it right back, is it?
No, definitely not. It's broader. The IRS says you can't claim a loss if you buy a substantially identical security within 30 days before or after selling the first one at a loss. And substantially identical can include options. Specifically, buying a call option on the same stock you just sold for a loss.
Ah, okay.
So if Taylor sells stock XYZ at a loss, then buys a call option on stock XYZ within that 30-day window, the loss on the stock is disallowed. That disallowed loss gets added to the cost basis of the call option and the holding period for that call option. It actually inherits the holding period of the stock that was sold.
Whoa, that adds layers.
It does. It affects the basis and holding period if you eventually exercise that call too. And similar logic applies if you sell an option at a loss and buy a very similar option back within 30 days.
Man, keeping track of all this. Okay, briefly, what about straddles and maybe day trading options?
Straddles have a specific loss limitation rule. Because you're holding opposite positions, a call and a put, the IRS limits your ability to claim a loss on one leg if you have an unrealized gain on the other. You can only recognize losses to the extent they exceed the unrealized gains on the offsetting position.
So you can't just cherry pick the losing side.
Right. If you close the call for a $500 loss, but the put is showing a $300 unrealized gain, you can only claim $200 of that loss right now. Day trading options. Generally, if you're opening and closing positions within the same day, gains and losses are treated as short-term capital gains or losses, not usually ordinary income unless you qualify for trader tax status, which is a whole different topic.
So boiling down this whole section on options tax, the main takeaway seems pretty stark, doesn't it?
Yeah, I'd say the single biggest risk, maybe even more than bad trades, is misunderstanding these tax rules. Turning long-term gains short-term, missing wash sales. You absolutely have to report profits and losses. Getting familiar with these rules is step one. Step two, seriously consider talking to a tax pro who gets options. This stuff is complex.
That's a really solid summary. The details matter hugely. Okay, let's pivot now. Away from traded options and onto something else people encounter. Stock warrants. Similar vibe to options, but different, right? What exactly are they and how do they differ?
Yeah, they feel like call options. They give you the right, not the obligation, to buy company shares at a certain price, the strike price, before they expire. The big difference. Warrants are issued by the company itself. not by some third-party option writer like on the exchanges.
Often from your employer, maybe?
Very common, yes. As part of compensation, or sometimes issued to investors alongside bonds or other deals. And importantly, warrants can often be traded on the secondary market. And even if the stock price is below the strike, what we call underwater, the warrant might still have time value. That's the value based on the chance the stock could go up before expiration, plus volatility.
Okay, so you've got a warrant. What are your choices? Exercise it or sell it?
Those are the main two, yeah. Exercise. Makes sense if the stock price is above the warrant strike price. Say, $40 strike, stock's at $50. Exercising lets you buy at $40. You could immediately sell at $50, lock in that $10 difference minus costs. Sell the warrant instead. This is usually the move if the stock price is below the strike. $40 strike, stock's at $30. Why exercise and pay $40 when you can buy shares on the market for $30?
Makes no sense.
Right, but that warrant might still be worth something on the market because of that time value we mentioned. Someone might buy it hoping the stock recovers. And then there's just holding on. If there's plenty of time left and you think the stock has more room to run, maybe the stock goes from $50 to $80 with your $40 strike warrant. Holding could be much more profitable than exercising early.
That flexibility is definitely interesting. So, practically speaking, how do you do it? How do you exercise a warrant you hold?
Usually the easiest path is through your broker. They'll handle the communication with the company's transfer agent. Warrants often just show up in your brokerage account listed like any other security. You just contact your broker, tell them, I want to exercise X number of these warrants. They handle the process. The warrants vanish. The stock appears. Do be aware, though, your broker will almost certainly charge a fee for facilitating the exercise. Sometimes it's called a reorganization fee or something similar.
Good to know about the fee. Now, are there other sort of hidden complexities with warrants we should be aware of?
Oh, definitely. Two big ones. First, dilution. This is fascinating, actually. When a warrant is exercised, the company doesn't just find existing shares, it issues brand new shares.
Ah, increases the share count.
Exactly, which increases the total shares outstanding. That dilutes the ownership percentage of all the existing shareholders. It's a key difference from listed options. Second, the warrant ratio. It's not always one warrant equals one share. Absolutely. You might need 5, 10, sometimes even 20 warrants to buy a single share of stock. You have to read the warrant agreement details carefully to know the terms. And back to selling, that time value point is crucial. Even if the stock's at $50 and the strike is $40, so $10 intrinsic value, if there's lots of time left, that warrant might trade for, say, $12. That extra $2 is the time value premium. Someone's paying for the chance it goes even higher.
And selling those warrants is just like selling a stock or option in your account, right? Put in your price, quantity, and hope for a buyer.
Precisely. You just place a sell order through your broker like any other security you might trade.
Okay, so we've really covered a lot of ground. From the nitty-gritty of options taxes, qualified calls, wash sales, to the practical steps for dealing with stock warrants. It really feels like understanding these details isn't just for the Wall Street pros. It's essential for anyone dealing with these instruments to make smart choices and, frankly, avoid nasty tax surprises.
Absolutely. And if you connect it all back, the big picture takeaway is just how much the fine print matters in finance. Holding periods, strike prices relative to market, expiration dates. These seemingly small details can have really significant financial consequences. It definitely raises an important question for everyone listening. How closely are you really looking at the details in all your financial arrangements?
That's a great point. Consider how just one day or a few cents on a strike price, as we discussed, can completely change your tax outcome for options. Makes you wonder, what other parts of your financial life might have similar hidden complexities just waiting for a closer look?